Central Florida Real Estate Investors, it's Alex Bogomil, owner-operator of Capital Fundings. I'm here to give you our monthly update, our state of the market update, provided with data from Aura, and then we'll also take a look at the national real estate market, what's going on, and then talk a little bit deeper about what's going on in Central Florida. Let's jump in. This month, we're going to start off with update of the 30-year fixed rate mortgage, and we can see right here, it's 6.74, and if that sounds familiar, it is, because it's been holding steady. If you come down here to our one-year chart of the 30-year mortgage, it looks almost like a flat line if you smoothed it out. And it is. So 1 year, 6.78. Fast forward 1 year, 6.74. So almost no change. We're still getting hints of that Fed drop. I don't think it's going to affect anything. This could be the new normal. All right, so instead of jumping into the Central Florida market, let's first start off with some U.S. charts to give you an idea of kind of globally what's going on out there in real estate. U.S. existing home sales are hovering near historic lows when adjusted for population levels. So if you take the units sold, divide it by the average number of households in the U.S., you're going to come up with a figure. This kind of enables you to compare prior history to current history. Obviously, the population growth in the United States. So historically, if you're taking a look at this chart, we can kind of start here around 2005, 6, 7, 8, when everything started getting into trouble. That percentage was 6.5%. So once again, that's going to be number of existing home sales divided by U.S. households. So that hopefully adjusts everything. So we're looking at a level playing field. Now, fast forward out to 2025, you're seeing that we're falling in this historically low level range, around 3%. It's actually 3.1%. So regardless of the number, if you just look at the trend, it's going down, 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 3.1%. So historic lows of existing home sales. That's not good. So monthly shift in U.S. home prices. This is by month. So we're also, now we're able to compare apples to apples on a monthly basis. If we look at 2025, what you're gonna see is that we're trending worse compared to the prior years for almost every single month. So we know that these months are the hot months, April, May, June, July. Summer sales should be going up, but you'll see right here, everything is trending downward compared to 2024, compared to 2023, 22, and 21. So it's trending downward. So what would that tell us? If we follow the same trajectory for July, August, September, October, November, we may be a little bit worse on prices than they were in 2024. So we can expect a further decrease in prices. And this is, again, on the US level. So we're going to jump in at the end and we're going to show you by metros in Central Florida and Florida. Miami, Tampa, Orlando, all at the wrong end of the spectrum here. 1 year change in home prices, June 24 to June 25. Orlando and Miami coming in a little over 3%. Tampa really heading it hard, about 6%. So kind of what we're seeing, what we've been talking about, that 3 to 4% price drop year over year. Here on the new construction front, this does affect our existing home flips. So we always want to be constantly aware of what's going on in new construction, but the number of unsold completed homes for sale is at a rising rate. 2021, 40,000. So as the market slowed up, the number of homes that new construction home builders have completed are sitting unsold has continued to rise. So we want to keep an eye on that. I know all the big builders just released earnings, margins are compressed, but they're still doing actually pretty well. And then last month we talked about that spread between the 10-year treasury and the 30-year mortgage rate. And if that went back to historical numbers, we may see a reduction in the 30-year rate, which is what we're trying to get to, that goal of 6% or under. So you'll see historically kind of around that 1.5 range. Here's where we're at now, 2.5 range. So a 2.5% interest difference between the 30-year mortgage rate of 6.74 and that 10-year treasury yield. A lot of analysts are saying, man, if we can get back down to 1.5, maybe that would further allow about 75 to 100 basis point reduction in the 30-year mortgage. I say not so fast. Why? Because this graph kind of gives you an explanation as to what happened when we experienced those really, really ultra low mortgage rates a few years ago. So if you want to take a look at the 30-year fixed rate mortgage over historical, it's been boxed out here, QE and ZIRP. What the hell is that? QE, quantitative easing, ZIRP, zero interest policy. So these were policies enacted by the Fed in 2009 up until about 2022. The Fed was an active buyer of aftermarket mortgage-backed securities. What that did is influx a lot of liquidity into the mortgage industry, and that helped reduce yields. Now, it was artificial. The Fed was doing it. They actually accumulated almost $3 trillion of mortgage-backed securities onto their balance sheet. Well, they stopped doing that right before they hit $3 billion. They stopped doing that. And now, what are they doing? They're letting all those mortgage-backed securities pay off, as mortgage-backed securities do over time, and taking those proceeds and now investing in them into treasuries. So now, instead of artificially propping up the mortgage world, they're propping up the treasury bond market. So you're getting that downward pressure now on rates for treasuries, while the mortgage rates kind of float back up to the normal. And take a look at this. If anyone's thinking that we're going to drop to 5 and stay around 5, the range for that 30-year historical mortgage rate is about 6 to 9%. So at 6.74, we're actually doing pretty good. We'll see what goes on. So what does all this mean? It means that we're kind of seeing very similar stats come in. It means kind of we're floating along without having any major disruptions in the marketplace. Credit this to bigger pockets. They think kind of how I feel, that as long as we keep getting these performance metrics, that everything's going to be steady as we go. And correction factor number 5, they're saying there's not a big correction, it's just a mild correction. So the sky is not falling, we're not hitting this huge crash, it's just a mild correction to kind of pull back all those monster gains that we had post-pandemic. No distress in the system. Now, here are a couple of points that they pointed out that are definitely worth sharing. Fannie Mae reports single-family delinquency rates of 0.55%, down from April. That's good. Fannie Mac reports multifamily delinquencies of 0.46, flat from March. Fannie Mae's multifamily delinquency rate dropped to 0.66%, down from April's high. So we're not getting new highs on delinquencies, which are going to further eventually come out to be foreclosures. So that's some good news, not crisis level numbers, they're saying. In fact, still below pre-pandemic averages. So again, the sky's not falling, but let's keep our eye on things. All right, now let's dive into some Central Florida market numbers. The state of the market put out by Orlando Regional Realtor Association. Now this is from June, because obviously they closed out the books in July. And so we're a couple days late on it, but I want to give you the information. And it kind of states similar to what we saw that we just talked about, is that nothing is crazy negative. It's almost flat, which after experiencing the last few months and pretty much all of this year of continued downward numbers, flat is actually a good thing, I think. So what we are seeing, let's take a look at month-to-month changes right now. Inventory dropped a little bit. New listings dropped the most significant, 8.4%. New contracts dropped. Total pendings dropped month to month. Closed sales dropped slightly. Average prices about the same. Median price held steady. So days on the market actually dropped slightly. Average days to sale about the same, and months of supply about the same. So we're seeing a lot less people come to the market, and that's because a lot of them are getting frustrated. A lot of people are pulling their listings off because they're not moving, and then a lot of people have just decided, hey, I'm not going to put my house up for sale. The interest rates I don't like, or maybe we're going to wait a few more months to see what that economic indicators are talking about. Right now, CPI inflation indexes are very neutral. Job reports are good, but we're, like I said, when we started doing these state of the market reports, it's going to be a month-to-month analysis right now till we can kind of clear off some of this bad inventory. Maybe rates go down, and maybe we can start seeing an upward trajectory in pricing, inventory, and closed sales. All right, so let's give a little bit larger than Central Florida, but let's take a look at the metros of the areas that Capital Funding services. We're going to jump into our Reventure app, look at home price forecast. This is for the next 12 months. And let's just take a look at some of these starting up in Ocala, negative 8.3% for the next 12 months. Deltona, Daytona, negative 7.8%. That's about consistent as it was last month. Going down the coast, Palm Bay, Melbourne, Titusville, negative 8%. Itching slightly higher than last month. Orlando, Kissimmee, Sanford Metro, about the same. Lakeland, Winter Haven, that's experiencing some more drops, 8.6, slightly higher than last month. Definitely seeing a little bit of weakness in any of the loans we've had in Lakeland. So we take that into consideration for pricing. Tampa, St. Pete, that has dropped a little bit more significant, 8.4%. Northport, Bradenton, Sarasota, negative 8.5% year over year projected sales home price forecast. So we're still seeing a lot of the same. Some of the metros have actually decreased a little bit, and some are staying the same or holding steady. Orlando, Kissimmee, Sanford doing that. I think Orlando, out of everywhere between Tampa, Orlando, Miami, it's really positioned well. We've got a ton of growth going on. We've got a ton of capital infrastructure projects going on with huge billions of dollars of new roads being built. So I think Orlando is really positioned well compared to some of the other metros for investment opportunities. All right, so what does all this mean to you, the fix and flipper that's just buying a house that you think looks like a good deal? Well, here are some tips I want you to keep in mind when you're looking at your next fix and flip. First of all, tighten your budget, and you can do this in multiple different ways. One, project out longer holding costs. The properties are sitting on the market a little bit longer. Even if you're getting a contract in 14 days, there's about 20% chance your first contract will fall out. We're seeing that on a US basis. So that could add to your holding costs. So you want to budget that possibility in. Two, we want to build in a concessions. Talk to a lot of our borrowers. I do that throughout the week. And a lot of them are saying, Alex, I'm just forecasting 3% concessions because that's what a lot of the buyers out there are looking for and need. You know, the loans from what we're hearing aren't as solid as they were in the past. So you really need to help them out as far as the cash flow positioning or debt coverage ratio. You really can help them out with concessions. So build that in 2 to 3%. I would go 3%. Why estimate low? And then thirdly, your current comps. If you're projecting out what that after repair value is going to be, you don't have to look any further than to our venture analysis to know that what you think it is today may be 5, 7, 8% lower in a year. So how fast are you going to get that renovation done? If it's going to take you 6 months, you may need to drop your estimated ARV right now based on today's comps, a 3.5%, 4% to account for that possible future price decline. So tighten your budget, very important. Inspections, I always preach this. I actually had a borrower reach out to me yesterday, said, Alex, I got an inspection on a report, and then the buyer came through with their inspections and still failed, and they bailed on the contract, and now I'm not getting as many showings. And he goes, I took your advice. I got the inspector I always use. And he goes, but apparently they're not that good. So find a reputable inspector. We know a few. If you want to reach out, we can make some recommendations, but get that inspection done before you go to market. That way you'll capture everything that's wrong that buyer who's super picky right now is going to catch if you don't. And then stay below the market. We always talk about pricing your property below what's currently out there as your comparables. You want to stay ahead of them. Buyers have more inventory to choose from. They're going to be looking at not just yours, but other properties, including renovated properties. So you want to be a little bit ahead of the game, and you want to advertise that you're offering concessions if you're offering concessions. 2 to 3% is what we're seeing. Again, put it out there, let them know. The goal is to move these properties. Not everyone's moving these properties. We're having a lot of borrowers come to us and say, hey, we want a DSCR out and we're going to revisit the market in a year. I don't know if that's always the right solution, but it is a solution. And we're seeing that more and more. So be aggressive right out of the gates. If you're flipping houses right now, it's probably not the time where you're going to hit all home runs. Take that single, take that double, move on to the next one. Hopefully we keep clearing through inventory, and then the market will see some increases. All right, I hope this helps. Let us know what you guys are seeing out there. And ladies, on your fix and flip property, are you getting contracts? Are you deciding possibly to refinance? Any tips? I'm also hearing, as far as a tip, a lot of people, open houses are very, very useful right now. People threw them out years ago. No realtors wanted to do them. Now they're actually getting a lot of buzz. People are going to open houses and getting contracts from open houses. So that's something I would recommend. If you've got any tricks you want to share with us so we can share with the other fellow Central Florida investors, let us know in the comments below. If you find this useful, please like and subscribe to our YouTube channel or any other platform. And hopefully you can help use Capital Fundings to make you a little bit more profitable on your next fix and flip. All right, we'll see you on the next update.